Reporting on Brevard Real Estate, I'm Abby, founder of Abbey Road Realty. Here with us is Brian Hawkins from Shelter Mortgage. Thank you for joining us today.
Abby, thank you so much for having me.
Walk us through the process of how the mortgage process works.
The first thing that we're going to do is get pre-qualified, and the pre-qualification process is we're going to verify their income, we're going to verify their assets, and we're going to verify their credit.
Regarding the credit scores then, what is the magic number? What do we need?
That really,
range?
it depends really on the type of product that we're talking about. Each different product has its own minimum required credit score. Product, like say for example, like a VA loan with the Veterans Administration, which is specifically for active military or retired military, is 620. And that's the middle of the three credit reporting agency scores. So we're going to look at all three scores, we're going to take the middle one, and that's the one that we use.
Okay.
FHA, which is the Federal Housing Authority, or Fannie Mae as a lot of people know it, is 640, and conventional, so we like to keep those at around 660 for it to be it can be cost prohibitive if it's below 660.
Okay.
So, but we can go down to 620 on a conventional frame point.
How about programs like USDA?
USDA is 640 as well.
Okay.
And then we compare their income against their debts, and this would include a future house payment.
So what is a good ratio to be on?
We look at two different ratios. One is the housing ratio, which is where we compare what the house payment's going to be, and the house payment is going to be their principal and interest that's going to be paid back to the bank, plus their taxes and their insurance. And if they don't put 20% down, PMI, which is private mortgage insurance.
Do you include the homeowners associations as well?
We do that in terms of calculation, but it's obviously something that they're not going to pay the bank each month. They will pay that directly to the association, but we do take that into account in terms of calculating what their house payment's going to be. And then compare that to their monthly income. And we like to see that around, ideally, 28 to 29% of their house payment to their total income. Total debt is where we take their house payment in addition to if they have a car payment, if they have credit cards, if they have to pay something like alimony or child support, any other payments that would show up on a credit report that they are required to pay. And then compare that to their income as well. Again, ideally we like to see around 36%, but most programs can go to 42%, and even in some cases even up to 45%, again with strong extenuating circumstances.
So what are the requirements for documents?
That's a wonderful question. Really, for someone who is an hourly or salary person, we would need to show 2 years of tax returns. We would need to show 2 years of the W-2s that go with it. In addition to that, we would need to show 2 months of pay stubs. Assets, because in regards to purchasing a home, you're going to have down payment, depending on the type of program that you're using, and then of course your closing costs.
So what else? Tell us about what kind of requirements for down payments.
Some certain programs, like the USDA program, which is a rural program for not in cities but out in country communities, and the VA loans are 100% financing, or can be up to 100% financing. So it's a tremendous program for someone who does not necessarily have down payment money, but has the means to repay a loan that they can get 100% financing. FHA, as the program stands right now, is 3.5% down. Conventional loans, and based on credit, can be as little as 3%.
Join us next week for the second part of the interview. Reporting from Brevard County, I'm Abby Barbosa.